Believe it or not, in the mid-1800s, aluminum was a sign of wealth. Rich women wore jewelry made of aluminum, and the Emperor of France gave his most important dinner guest cutlery made of aluminum. You see, at the time, aluminum was extremely expensive. It was worth more than gold. Now, we all know that isn't the case any longer, but let me ask you this. Which do you think is more expensive today? This bar of gold or this bar of platinum? If you asked me this question 20 years ago, back when I was in high school, I wouldn't have hesitated. I mean, look at all the rappers from back then with their platinum chains and their platinum watches. If they were wearing platinum jewelry, it had to be expensive. And well, yeah, it was. Platinum was worth a lot, and it was significantly more expensive than gold was 2 decades ago. $750 a troy ounce versus $350 for gold, or double the price. But today, that ratio has flipped. Gold is now double the price of platinum, $1,900 per troy ounce versus $900. Which raises a couple of questions. Why is gold so much more valuable than platinum today when it was the other way around for most of the past 100 years? And should you be buying either of these metals as an investment? Well, to answer those questions, we need to understand what makes gold and platinum different, but also what makes them similar. As you probably know, both gold and platinum are precious metals. A metal is considered precious if it's rare and it's valuable, and that can change over time. As you might have guessed from the anecdote at the beginning of this video, aluminum was once considered a precious metal. It was expensive even though aluminum is the most abundant metal in the Earth's crust because aluminum bonds very easily with other elements. And up until the late 1800s, people didn't know how to cheaply and easily separate it from those other elements. Once they figured out how to do that using a technique called electrolysis, the price of aluminum plunged. Now, obviously, gold and platinum are different. They're much scarcer than aluminum is, so it's always been hard for people to get their hands on them. But that alone isn't what makes them valuable. For example, another metal, ruthenium, is 3 times as rare as gold based on the amount that's in the Earth's crust, but it's only a fourth of the price. So what makes a metal valuable or not isn't just the amount that exists on Earth. It's how much people want to buy it combined with how much is available for sale. Now today, the majority of gold and platinum that's available for sale comes from mining operations. Most of the platinum that's mined in the world, or a whopping 70% of it, comes from South Africa. On the other hand, gold mine production is distributed much more evenly across the world. China, Russia, and Australia account for roughly 9 to 10% of global gold mine production, while Canada, the US, Indonesia, Ghana, Peru, and Mexico account for roughly 3 to 5% of world production. So mine production is where most of the gold and platinum that's available for sale comes from. But that's not the only source of gold and platinum supply. You see, all of the gold and platinum that's ever been mined is still around in some form or another. It's estimated that 200,000 tons of gold and 10,000 tons of platinum have been mined throughout history. Most of that above ground stock of gold and platinum isn't available for sale because people are using it in some fashion. But every year, a little bit of the existing stock is resold onto the market, and that's known as recycled metal. When you combine mine production with this recycled metal, you get the total supply of gold and platinum that's available for sale, which is one half of the equation that determines how valuable these metals are. The other half is, of course, demand. Demand for gold and platinum can be broken down into 3 broad buckets: jewelry demand, industrial demand, and investment demand. As you know, both gold and platinum are widely used for jewelry. About half of global gold demand comes from jewelry, while around a quarter of global platinum demand comes from jewelry. Both of the metals are also used in industry. Gold is used in electronics and dentistry, while platinum is used in the chemical, glass, medical, and automotive industries. But while both have industrial uses, platinum is much more of an industrial metal than gold is. Only 8% of gold's demand comes from industry, which compares to 72% for platinum. In fact, more than a third of platinum demand comes specifically from the automotive industry, where the metal is used in catalytic converters to reduce the emission of harmful gases from vehicles. I'll get more into that in a minute, but before I do, let's talk about the third category of demand: investments. Gold and platinum are used by people to store their wealth and to protect against inflation. This investment can come in the form of physical bars and coins, or it could come in the form of ETFs, which trade like stocks and hold physical platinum and gold on behalf of investors. Now, while platinum is considered an investment by some, the demand for platinum as an investment isn't that consistent. For example, in 2020, investments in platinum bars, coins, and ETFs accounted for 14% of total platinum demand, while in 2022, platinum investment demand was negative, meaning that investors were net sellers of platinum. That contrasts with gold, which has a very large and consistent source of demand from investors. Gold investment, which primarily comes in the form of physical bars and coins, but also includes gold ETFs, ETF purchases is typically around 30% of total gold demand, though it can get as high as 50% in some years. That said, it's not just individuals who store their wealth in gold. Central banks around the world also buy the metal as part of their foreign exchange reserves. In recent years, central banks in China, India, Russia, Turkey, and many other countries have been stocking up on gold. And this demand has accounted for roughly 14% of total gold demand over the past 5 years. So now that you're familiar with the supply and demand drivers of gold and platinum, let's talk about why gold has performed so much better than platinum over the past couple of decades. There are really 3 main reasons why gold in particular has performed so well. One is that central banks of developed countries stopped selling gold. You see, for about 100 years, most countries in the world operated under the gold standard, where paper currencies were convertible into physical gold. To keep this system running, central banks accumulated reserves of gold. The gold standard eventually morphed into the Bretton Woods system, in which US dollars were convertible into gold while other currencies were convertible into dollars. In the 1970s, that system collapsed, which gave way to the current system of fiat currencies, which aren't convertible into gold or any other asset. With no need for gold, central banks started to sell off their reserves of the metal. Those sales lasted for years, but they finally came to an end around a decade ago, which is around the time that central banks in developing countries began to aggressively purchase gold to diversify their foreign exchange reserves, pushing up demand for the metal. So central banks went from being net sellers to net buyers of gold. That's reason number 1 why it's performed so well. The second reason gold's done so well is because of the rise of the Chinese and Indian economies. As Chinese and Indian consumers have gotten richer, their demand for gold, a metal that holds great cultural significance in those countries, has risen in lockstep. Demand from China and India represented around a quarter of global gold demand 2 decades ago. Now it accounts for 50%. Finally, the third reason that gold has outperformed over the past 2 decades is because it's been increasingly recognized as a store of value and as an investable asset. This kind of ties into the growth of demand in China and India, but this is a global phenomenon. Gold has a long history of being considered a safe asset that tends to hold its value over time. But there was a period of around 30 years after Bretton Woods collapsed that people kind of forgot about it. Over the past couple of decades, people have started to embrace gold again. The introduction of gold ETFs, which make gold extremely easy to buy and sell, the ascendance of China, India, and other emerging markets, and central bank purchases are all factors that have enabled gold to make a comeback. If you look at this chart, you can see the dramatic transformation of gold demand over the past 20 years. Whereas jewelry demand made up the bulk of demand during the late 90s and early 2000s, today, much more demand is coming from investors and central banks. That's why gold has done well. Now let's talk about why platinum has done so poorly. Remember that unlike gold, platinum is primarily an industrial metal, with 35% of demand coming from the automotive industry alone. And what we see is that recent trends in the automotive industry haven't been favorable for platinum. As I said earlier, platinum is used in catalytic converters to reduce vehicle emissions. Starting in the 1970s, the US and other countries started requiring automakers to put these devices in their vehicles to reduce harmful emissions. Initially, automakers used platinum as the key catalyst within these devices. But eventually they turned to another precious metal, palladium, because it has similar properties and it was cheaper, 1/3 or 1/4 of the price. Automakers eventually settled on using platinum within diesel-powered vehicles and palladium within gasoline-powered vehicles, which sapped a lot of demand from platinum because gasoline-powered vehicles are much more prevalent. But that wasn't the only thing working against platinum. Over the past several years, platinum jewelry has gone out of fashion. Demand for platinum jewelry has fallen by more than half, from 2.8 million ounces in 2012 to 1.3 million ounces in 2022. So now you have a sense of why platinum has performed so poorly compared to gold over the past couple of decades. But what could happen from here? Well, there's expectations that over the next few years, platinum demand in the automotive sector could tick up. You see, a funny thing happened over the past few years. As demand for palladium for use in catalytic converters increased, the price of palladium exploded. For a few years, palladium was trading at 2 to 3 times the price of platinum. Even today, it's trading at a 33% premium to platinum. Naturally, that's going to cause automakers to substitute palladium for platinum in their catalytic converters. So that's good news for platinum in the short term. But the longer term picture for platinum looks more challenging. Battery electric vehicles don't contain any platinum or palladium, which means that as consumers increasingly shift towards those vehicles, the demand for platinum and palladium may fall. On the other hand, hydrogen fuel cell electric vehicles contain more platinum than traditional gas or diesel powered vehicles. There's been some interest in fuel cell trucks because they have more range and quicker refueling times than battery-powered trucks. If we see growth in fuel cell EVs, that could be a driver of platinum growth longer term. Of course, if we see platinum jewelry come back in fashion, that could be a catalyst as well. So the long-term bull case for platinum rests on seeing enough growth in these use cases for platinum that it offsets demand loss from battery-powered EVs replacing traditional vehicles with internal combustion engines. Okay, so that's platinum. How about gold? Well, for gold, the investment case is different. Remember, the investment case for gold isn't dependent on gold's use in industry because that makes up a small portion of total gold demand. Rather, it's demand for gold jewelry and arguably more importantly, demand for gold as an investment and central bank reserve asset that's going to drive the price of the metal long term. Last year, central bank gold demand hit the highest level ever, and demand for gold bars and coins hit the highest level in 10 years. In turn, the price of gold got really close to all-time highs. So I'd expect that dynamic to continue. If gold investment demand keeps climbing, that should bode well for the price of gold. Now, you might have noticed there's a bit of a self-reinforcing effect when it comes to gold. The price of the metal goes up as more people invest in it, and the high price encourages more investment in gold. And that's true. Gold's value comes from a collective belief that it's valuable. A lot of people agree that gold is valuable, so it is valuable. Not many other assets have this quality. Some of the other precious metals like platinum and silver kinda do, but not nearly to the extent of gold. And that's why I find gold to be interesting. There's clearly demand for a safe haven asset that's uncorrelated with other investable assets. The price of gold tends to do its own thing. It usually doesn't move up and down with the stock market or the bond market. And that's a nice feature to have in your investment portfolio. That said, gold isn't an asset that's going to deliver eye-popping returns. Since the first US-listed gold ETF, the Spider Gold Trust, launched in 2004, it's delivered returns of around 300%, which comes out to 7.5% annualized. That's not bad. It's better than the returns that T-bills, treasury notes, and corporate bonds have delivered, but it's less than the return for the stock market. Not to mention, those returns came during a period when gold performed quite well. There's been periods where it hasn't done as well, like in the 1980s and the 1990s when the price of gold was essentially flat for 2 decades. So this is how I see gold. It's a portfolio diversifier that has the potential to deliver decent returns if you hold it over the long term. But like any commodity, the timing of your purchase makes a huge impact on the returns that you see. Personally, gold isn't something that I own right now, especially with money market funds yielding over 5%. If I want a safe asset, I'd rather buy treasuries today. But if interest rates go down, then gold might start to look a bit more attractive compared to the other options that are out there, especially if the price of gold is down. If we see a 20 to 30% drawdown in gold, I might add a little bit to my portfolio and then sell it when prices rebound. But it's not the type of asset I'm gonna buy and hold forever. Hope that helps, and follow for more investing insights.